Good afternoon, everyone. I'm Tanya Tatro with CG, and I'm here with Rob Tatro, Portfolio Manager at CG, as well as a special guest today. I love that we've got my dad on the show. Claude is here today as well. So today we're going to be taking questions from all of our viewers. I'm sure that everyone kind of wants to know our opinion and our forecast, what's happening in the markets right now. So that's exactly what we're going to do today. We're going to answer your questions. So feel free to go ahead and leave those in the comments section, YouTube, Facebook, wherever you're at today. And maybe what we'll do is we'll just get started, just kind of see how everyone's doing today. Rob, maybe I'll start with you. How's your training going?
Well, I'm a little underdressed apparently. Every time my dad comes into a meeting or every time my dad's on the show, he always puts us to shame with his shirt tie combo. I'm feeling great, Tanya. Feeling really good. Life's been good. Well, I had an injury in my knee, so my jogging has taken a little bit of a backseat. I've actually not jogged in like 3 weeks, so that's frustrating for me. Those who've followed kind of what I'm doing know that I'm kind of addicted to running right now, and I'm training for an Ironman, which is a month today. I'm doing an Ironman and I'm not able to run. So that's a little frustrating. My physio, Quentin Raval from Desert Raval Therapy, Physiotherapy, who's unbelievable, by the way, he's been working me back, swears that I'll be ready in a month. So I see him tomorrow. So hopefully I get the green light to run this weekend. But I've been biking a ton and swimming a ton. My swimming, Tanya, you should see, I've trimmed like another 10 minutes off my personal best for like the Ironman distance, which is 3.8 kilometers. So I'm feeling the best I've ever felt in the pool. Biking, biking's kind of it's kind of not as fun as jogging. But anyways, I'm biking a lot and I've improved that as well. So I do feel very, very good about things. My wife is back to jogging. She ripped and shredded her MCL, ACL, and meniscus, and she's back to jogging. So kids are pumped, right? The snow is kind of like if you're in Winnipeg, you have another after the time changes, you feel like, all right, you're ready. Life's getting back to normal. So kids are pumped. They're playing outside now. They're starting to talk about the pool being open and all that. So
Yeah, it's a shame
that's
that you
my
can't run because now you can like run more outside. But you know what I was going to
yes.
say is that it's a signal. It's a signal. It's an opportunity for you to work on your bike and your swimming. Running's your strong suit anyways. So this is just give you a little bit of an opportunity to work on your other stuff for your
Yeah.
Ironman.
Yeah. Focus on what you can control, right? I can't control my injury, but I can control the working out I'm going to do from now till April 22nd, which includes 5 hours of biking this weekend on Saturday. Like I think I have like 10 hours of training this weekend. So this is like the core piece of the training where you're ramping up your training a ton before you taper for the race. So I'm excited about this weekend. Sorry to hijack the conversation and make it all about running and biking and training, but that's what my life is like now.
No, that's all good. You got to have some balance there, and you know what? It's really important for us when we're making these decisions for our clients for us to be in the best shape that we could possibly be as well. So I like that. On the positive side, my training's going well too. I'm managing to still ramp up the running volume and gain weight, which I'm trying to do, and put weight on I actually hit a PR on my sumo deadlift. I usually pull conventional deadlift and I switched it out. So I hit a personal record on my squat, my deadlift, and my bench press and my running. So I don't know how that's
I
actually
bet you it's
possible.
because you're running.
I would say it's despite the running.
All right, whatever. I don't know anything.
All good. So, Claude, how are you feeling these days, too? It's been a while since you've done one of these for us.
Yeah.
I know you've been running. You're back to running a little bit too, right?
Yeah. How do I look right now?
You look fantastic.
That's,
Unreal, Claude.
that's exactly how I feel.
I like
No,
it.
I feel great.
Good.
When was your last chemo round of chemo?
Oh, I had my last one of chemo in September, so it's been a full almost 6 months now since my last chemo, and I'm feeling great. And just a little bit of monitoring by the doctors and cancer care. But other than that, I'm almost back to a normal life after 2 years of not quite a normal life.
That's like 2 years last week, right? Was the
Yeah,
what
two
was it?
years on March 18th, 4 days ago. 2 years and 4 days when I was admitted. Yes.
That's the
Wow.
night I thought you were gonna die. Awkward silence. It
Well, I
definitely.
thought so too, but here I am. So it's pretty good.
So glad you're here. So glad you're here.
Yeah.
And we traveled. We got to go to LA together for that race, for that marathon, and you're back to helping out around the office. And for those that don't know, Claude is as sharp as ever. He turned 70. I guess I shouldn't age you. Sorry, I shouldn't have done that. I'm 42. I should not have done that to you, Claude.
I'm 45. Okay, it's all out there now. All transparent.
Yeah,
Well,
but anyways,
put your mind at ease. I'll be 71 in September. How's that?
71 in September. I'd say close to 50 years experience. We're thrilled to have you. You've been on my team for a long time. You've been helping me, and those that follow me on Global TV, on BNN, on my YouTube channel, they know. And by the way, take a sec, like, subscribe, follow, give us your comments, put some questions here. Those that know, I always refer to, I guess people make fun of me. Some of my fans make fun of me because I always say, as my dad would say, or, I was talking to my dad the other day, or Claude would always say, and I guess I've kind of worked all of the best knowledge that I've gathered and gleaned from what you've learned, and I kind of incorporate it now in my day-to-day life. So
What a
I'm
great
thrilled to have
opportunity
you
to
here.
have you here today, especially everything that's going on in the markets. You're the perfect person to ask when someone's kind of been in this business here, been in the industry for 50 years, whatever that is. I think that you're the perfect person to help us kind of navigate through some of these questions probably we're going to have today.
No,
I think we might.
only 48 and a half.
And how kind of cool is it that we've never done one of these, right, Tanya? Where it's the
No,
three of
not
us?
all three of us. I don't think so.
So we do this, like, I go to Marchand on the weekend. I hang out with my parents and my brother and my sister. By the way, there's a brother that's not on here, but he's on my running podcast, The Running Journey. If those of you want to get to know me and my brother, check out The Running Journey, which is our podcast. But we have these conversations at dinner time on Saturday or Sunday in Marchand when we go visit while the kids are playing outside or whatever. So it's kind of neat now. I kind of had the idea I think it was last week or 2 weeks ago, where we were all there and we're all talking about the market, and we're talking about, the SVB, and we're talking about Swiss banks. And I said, this is valuable content. I'm going to sound like Johnny Mox, our producer, or in Diego. I'm like, this is valuable content. Let's do a live. And I asked Claude and Tanya if you want to do it. And he said, yeah. And I said, all right, let's do it. So, I'll let you host, Tanya. Sorry, I was gonna.
Well, I think we have a question coming up here. So maybe we'll ask producer Diego to maybe start off with our first question. And for anyone else out there sitting, wanting to ask some questions, go ahead, put questions into the comments on any of our social media here. And what we'll do is we'll try to answer them as best we possibly can. So our first one's up here. Thanks, Diggs. First one is from Celia. Ooh, and Celia has the big question here. Are mortgage rates dropping in Canada? And maybe we have to qualify that answer with maybe a timeline, right? Who wants to field this one?
I'll let Claude start this, unless you want me to.
No, that's good. So mortgage rates depend on the Bank of Canada rate, which the chartered banks make their rates depending on that, and then the bond market. And after many, many years of low rates, in the last 12 months, we've gone up, about 5% or so, or 4.5%, 5%. And I wish I could answer you. I wish I knew myself exactly when it's going to happen. One thing we don't know is exactly when it's going to happen. However, what we do know based on history is that interest rates are not like a yo-yo, but they do go up and down over economic cycles. And it's self-correcting, and it's needed that rates go up. In a perfect world, it would always be the same, but it's not going to happen. Economy goes boom, and then economy goes, there's too much surplus, not enough cash, etc. All of these economic conditions make rates, and fiscal monetary policy is they adjust the money supply and the interest rates to control the economy. So the short answer is, it seems like we're close to the top. But I do not know more than anybody else. It looks like we've got maybe another half point. That's what all the experts say. And then rates, a lot of people are thinking rates will come down right away. I'm not so sure they'll come down right away, but what's right away? I think we may be flat. Historically, we go up, then we stay flat, then we come down, and then we stay flat, and then we go up, and then we come down. So we're still going up. Interest rates in the U.S. went up today 0.25 point. There's probably going to be another one, but we're certainly close to the end based on inflation going down.
Yeah, the key here, sorry, Tanya.
Go ahead.
Oh, I was going to say the key is why are interest rates going up? And as a reminder, we've talked about this in the past, but the reason interest rates are going up is because it is the tool that the US Fed can use. It's a lever that they can apply to reduce the number of free dollars in the system in order to, so by increasing interest rates, it encourages savings. And it doesn't do it like, I'm not going to save $1 million or 500 grand or 50 grand. We're all doing it incrementally more. So it's a little bit more saving, which means less dollars in the system, which means less dollars chasing goods, which means inflation comes down. That's why they're doing it. They're trying to bring down inflation. They're more worried about the problem of inflation than they are worried about a potential recession. They've kind of agreed that this is likely going to cause a recession, but we're okay with it because it's going to be somewhat minor. There might be a soft landing. No one's going to, we're not going to ruin the economy, but inflation could ruin the economy. So they've decided to increase interest rates, which is what they do in times. You increase interest rates when the economy is healthy, and you reduce interest rates when the economy needs a boost or a bit of a backstop.
That's exactly what I was going to say. It's the entire point. It is to fight inflation, is to raise those rates. So once the inflation problem is handled, then yeah, we should see those rates come down. But let me ask you this question: do you think that we'll ever see again the crazy low rates that we had kind of in the past, 5-6 years, where 2% and it seemed like we were pretty spoiled there for a little while. Very cheap to borrow for a good part of the last decade here. Do you think it'll go back down all the way down to where it was then? Well,
before I answer that, the key to coming back to inflation is that a lot of people ask me, well, what's wrong with having a little bit of inflation? Our wages are going up. And but nobody says, I like inflation because when I go to a grocery store now, my bill is 50% higher. So the evils of inflation are that, right? Is that it's a cycle that if you don't break it, we're all going to be losers because our wages go up, but then everything we consume goes up more. And therefore, we need more wages to pay for what we consume more, and it's an evil cycle. So anyways, so the bank is raising rates to fight this inflation. So to answer the banks, what they're trying to do is that if we have economic growth, let's say of 2%, economy, which is for a mature economy like Canada and the US, a 2% growth rate is what's expected. In good years, maybe 3%, bad years, 1%. So if interest rates should match your economic growth, right? So in a perfect world, if we go back to having a GDP growth of 2%, theoretically rates should come down to 2%.
Right, and mortgages being a little bit more there. It's like prime plus whatever. Yeah.
I think the banks, to go back, so we've talked a lot about interest rates, and just to make sure that we get back to the question, which was mortgage rates. So Claude mentioned this, but I'm just repeating it. The banks will follow the Fed, the Canadian Central Bank, and the US Fed, which kind of leads the way. So the Canadian Central Bank largely follows the US Fed, although maybe I could
not
ask
this time. Yeah,
maybe I could ask you this question. I'll finish that point, then I do want to address that question. Remind me if I don't get back to it. But because like our inflation's down to 5% now, right? Like our numbers are really good in Canada. But they're forced to follow the central bank, and that means they typically try to forecast ahead of time these mortgage rates, what it's going to be. So, when the futures were trading, we're anticipating a 25 or 50 basis point. They have algorithms, they have models. They don't just move the mortgage rate overnight whenever they try to factor this in ahead of time. They are a business, right? Banks are a business. So they're trying to figure out the optimal way, and they're all competing with each other for your dollars, for your mortgage, right? So they have to be somewhat competitive, and yet the free market works for interest rates in Canada. So to answer that question, I do believe we're in for a period of time here where mortgages are likely to stabilize, if that's the right word, because I already do think that next increase is probably mostly factored in, Claude. And then we might be, you're right, we might be 12 months or 18 months away from it recovering. And I don't think we're going to see that 1.6 6% mortgage, in the near future. It might happen again as the economy recovers. We get more technology, we're able to increase our growth, improve efficiencies for our economy and all that. But I do think that's further down in this next market cycle. I don't know if you agree or disagree with that, Claude.
No, I agree.
Now, what did I say I wanted to address,
We
Tanya?
wanted to talk about how usually all the other central banks follow the Fed, but this time actually the Canadian
Central bank.
central bank was actually the first to pause the rates this time. So there was actually a divergence there this time between the Fed and the Canadian.
Well, I want to address the inflation numbers in Canada. So I talked about this on Global News on Monday morning when they announced them. The numbers were, I think the numbers were phenomenal. We had a 5.1% top line number, which is unreal considering we were at 8.5 in June. So we've now come down 3.5 percentage points of inflation. Remember, this is a 1-year number. So if you actually look at the month over month number, it's pretty good. You're getting a deceleration in the inflation. So it's not deflation. It's just less inflation than you had the prior month. But I think 5%, we're no longer in a banana republic now. 5% is it's a number that is close-ish to the 2 to 3% kind of 1 to 3% target. So I was optimistic when I saw that number, Claude. I don't know about you, but for me, it was a bit of a reassurance that this is working. And I've said it every time we do these lives, Tanya. I always say it's going to work. Like this interest rate, you will see inflation come down, and we're seeing it now.
Well, it's the underlying mechanism. We know the underlying mechanism. The less you have the less you have too many dollars chasing goods. It's a fairly simple concept. So the question is just how long does it take to respond? And it looks like this time it has responded. The economy has responded reasonably quickly.
Yeah, I think my comment on that is I agree with Rob that I was a bit surprised that it's working that good. But don't forget that the central banks around the world have learned from the 1970s when the inflation cycle lasted 10 years, right? We slowly went up and then we peaked and then it took forever to come back down. And then when we came down, they learned, they controlled the money supply and all that. And then we had a great 10, 15 years after that. So this time, I know a lot of people criticize the Federal Reserve for having raised the rate so quickly in 1 year, like from basically 1 to 5. But they've learned from history that we have to nip inflation in the bud. And the most effective way to do it is by raising rates. And that's what they did. And it seems to be working very effectively.
I'm going to try to share my screen here. Is this going to work? No, it's not going to work. I was trying to share my screen. It's not working, right? Obviously
I'm not seeing it. But
okay, that's fine.
Maybe we can pull it up for a little bit later. Did you have a graph or a chart?
I was just going to show the historical inflation trend, and I was going to show the historical GDP growth.
There it is.
Oh, how did I do that? Okay, so this is the inflation you're talking about, Claude, kind of the 80s when we hit. So this is a year-over-year number of 12%, but there were periods in there that it was 18, 16%, right? Like you'd have 1 year-over-year number where you'd see like a top line of 15 or something like that, right?
Yeah, well, I mean, the Canada savings bonds in 1979, which is like short-term money, right? They're cashable anytime, hit 19.5%, which is comparable today to the savings rate of 4%. So just to show you. Right,
but we can't confuse. I know they're highly correlated, but we can't confuse inflation with savings bonds rates, right? Those are not the same. Just to be clear, those are not the same thing.
Well, they're relative to each other, but not the same thing. I agree.
Yeah, I mean, they're highly correlated in that. And here's your GDP growth. So this is Canada over the last 60 years. Averaging after the war, it was a booming time, and then kind of this is 2008, 2009 here, and then kind of some. This is more recently. So I just wanted to share that those two charts. Did that work?
It did.
Okay. Yeah. Did we switch around on your screen, or is it just me?
We
We
did.
switched
Yeah,
around.
we did. We're not
Okay.
in the same position anymore.
All right. I screwed up. Sorry.
Yeah.
All good. Well, anything else we want to talk about on inflation or interest rates? If not, we can
Well,
maybe move on to the
just
next
one
topic.
quick thing. So they announced the 25 basis point today, Claude, kind of a dovish increase, I guess. The language, it wasn't a hawkish pause. It was a dovish
Mhm.
increase.
Mhm.
I mean, I know that's what everyone was expecting, so it's not really news. Were you surprised in any way, Claude, or it's kind of exactly what you were expecting? Did you think they might pause just because of what's happening with the banks?
Well, I was hoping that like what we can't be doing is manage our economy on a day-to-day basis, something that happens over the weekend, right? So like the stock market, when you watch it on TV now, everybody is like minute to minute focused on, what's going to happen like in an hour from now or 2 hours or tomorrow. And I don't think our Federal Reserve and our central banks can run our countries based on what happened an hour ago. Sure, it was a major event, the SW Bank, but they said their number one focus is to tame inflation. And because the numbers are coming down, but they're still not right, in my opinion, it was the right thing to do. So
Do you
I
think
was not surprised.
do you think it still would have been a 25 beat increase if there hadn't been, any like regulators or anyone stepping in on any of these? Do you think it would have been the same scenario?
Well, okay, let's say the SVB Bank hadn't happened there about 2 weeks ago.
Mhm.
Um, I, I think that, yeah, it would have been the same or maybe even a bit higher.
Right.
I think it would have been 50. It would have been 50, I'm pretty sure.
Yeah, it would have been 50. The reason they didn't go 50 is they're trying to do the best of both worlds. If they raise the rates, well, there's going to be more banks, maybe a big problem there. So they're trying to put confidence in the economy by they had to continue to raise. So they did, the smallest possible raise of 25 to everybody's happy now.
The win-win.
Yeah.
Well, I think I think it was probably obviously they know more than me, but I think that was the proper move.
I think so too. I do have a question here online before I see Richard put in a question. Richard, former classmate of mine back in École Saint-Joachim, I believe
Mhm.
that's the same Richard, went to school together, K to 12. Actually, let's post that question now, Diego, if you can, and I'll get back to my other questions after. When do you think the market, sorry, this is your job, Tanya. I'm the
Well,
worst.
thanks, Richard, for the question. No, it's all good. When do we think the market will start to rebound? His comment is, it seems just when the market is going to turn and start gaining, some other doom and gloom story comes out in the market, just like recently with these banks, these bank collapses. So yeah, it does seem like that, doesn't it? But the reality is that you can make a lot of stories into happy stories, or you can make some stories into doom and gloom stories too. So there's a lot of different spin that you can have on there, but I can't wait to hear your take on this. Rob, do you want to go first on this one, or Claude?
Go ahead,
prefer
Rob.
Sure. Okay. So I think that the only way the stock market works is if there are consistently doom and gloom predictions, because otherwise, like, the market works on emotion, and you cannot get, so we know that over time, market cycles, you're being paid additional return in exchange for volatility. We know that. And how does the volatility happen? It happens with the media doing live doom and gloom predictions. It's not like it was in the 70s and 80s when my dad was trading stocks or whatever, when you had to get your news from a ticker, or you had to get a flying pigeon to bring you your newspaper, or I don't know how Claude was getting his news back in the 70s, but now it's 24/7 at our fingertips nonstop.
A paper newspaper that you had to wait for it to show up on your doorstep.
Imagine waiting for a newspaper. So I think the only way the market works is with some individuals predicting doom and gloom and media making that a story, and some individuals predicting the market's going to go up. But right now, those people are all shut up, which is, to me, is a bullish sign, right? Whenever all you hear is negative news, it's typically a good sign, because the market is historically contrarian to what humans are, how they're trading and what they're perceiving. So
The people who aren't talking are buying.
the people who aren't talking are buying, and the reverse also happens. So whenever the market gets frothy, And whenever, see, you don't, when the market does, I don't know, between 2018 and 20, or between, think of any kind of 5-year period where the market's averaged 15, 20% per year. It's happened a lot in the history of the market. During that time, it's almost like a referee analysis in hockey. If you don't hear about the referee, he's probably doing a good job, right? He's doing a great job, and you just want to focus on the game. Same thing with the stock market. If you're a retail investor, you don't want to hear about the stock market. If you don't hear about the stock market, that means you're probably making money. And all of a sudden you forget 5 years has passed and you've doubled your portfolio, or the S&P 500 has doubled. And yet we get a negative event and it's huge news. But yet we're still dramatically up from where we were 5 years ago or 10 years ago or 20 years ago. So these negative media events are a necessary evil in the market cycle, unfortunately, and they typically always present buying opportunities for the smart money. And I know maybe that's not the perfect answer, Claude, but that's kind of my vision of this. We need media to tell us how shitty the current situation is in order for some people to get out. They shouldn't have been in the market anyways. They're out. So now they're out. The sellers are out. And then the market can kind of recover and do its thing.
Yeah, the market can't work if everything is all positive or all negative. There has to be people on both sides in order for a market to actually happen.
But what causes the extreme volatility, and answer Rob's first question, back in the 70s, we had no computers. And as a matter of fact, we couldn't wait till the Financial Post published their yearly earnings report on companies. Like, you got earnings once a year on how companies were doing. But anyways, the reason to me for the volatility today, it's the media and all this, but throughout history has always been what I call the madness of crowds. And so what happens is when the market starts going up, people make money, people are happy, they tell their neighbors at cocktail parties, more people come in. Hey, I made 12% last year, I made 15%. Other people come in, and then first thing you know, businesses that should trade at $10 a share are now trading at $20 or $30 a share. So it doesn't make sense. So it has to come down. So it's healthy for the markets to come down. And then when the markets come down, like we've seen the last 12 months or 15 months, is that people are bailing out now because all of a sudden everybody's saying, I'm getting out of this market. I'm losing my money. I'm going to go to GICs or whatever. And there's more sellers than buyers, And it exaggerates on the downside what it exaggerated on the upside. But the long term is that economic growth at 3, 4, 5%, stock markets at 7, 8%. What it'll do in the short term, I have no idea. Nobody has any idea. But I do know that if in the market long term, you're going to be okay and you're going to make a lot of money.
This is exactly what I was going to say. Maybe the better question to ask is not when do we think the market will start to rebound, but maybe the right question to ask is,
well, I know when it is, Tanya, by the way. I'll tell you right here on the screen.
Let's hear it.
Yeah. The market will bottom when there's no more sellers and there's an influx of more buyers than sellers, and then the market will go up.
Oh, I love it. We have the real answer.
It's a bit of a cop-out. Answer.
Cop-out answer. But no,
we're getting close. We're getting close. And close to me is, a few days to many months.
Few days to a few months, to many months. But the reality is that if your asset allocation is the right one, if you have a good relationship with your advisor, the when does not matter, shouldn't matter, is maybe what I should say, is if you have that correct asset allocation.
Yeah, because let's think of a scenario where the worst possible scenario that you can think of for someone to be impacted negatively by the movement in the stock market, right? So what would that be potentially? Someone who is retiring tomorrow and needs to start to draw down on their capital. That's kind of the worst case scenario, right? So provided you have an advisor that you trust and they've put in place a plan, which I strongly advise you get a plan. If you don't have one, we do for every one of our clients. And if you're a client of ours and you're watching right now and you feel like you haven't reviewed your plan in a while or you want to review it, reach out, come give us a call, shoot us an email. We'd love to review your plan. But the plan enables and allows you to have liquidity in the event of a market crash. And how do we do that? So if we know you're retiring, you're going to have a portion of your portfolio that's either going to be in fixed income, short duration investments, liquid private debt, stuff like that, or alternative assets which we can redeem. And that way we don't have to sell your stocks, because we know that kind of the longest period, whether a market cycle is negative for 2 years or 3 years or 4 years would be kind of really bad. But even in those situations, for the retiree, there's liquidity that we can draw down on. Those assets have kept their value, and we could use the income that's being generated from the portfolio to pay for your retirement. So if you have, Tanya, I love your line. You said if you have an advisor, if you trust them, you have a plan in place, there's absolutely no reason to be panicking when the market does this, because we know it's going to happen. One thing if you invest in the stock market, and if you don't know this, I'm telling you now, there will be a period every 3, 4, 5 years where there's a significant movement in the index. And that means your stocks, even if you have the good stocks, even if you have bank stocks, even if you have quality names like, oh, I own nothing but the large cap and the biggest companies, they still drop 30% every 5 years. It will happen.
Yeah, I'd even go a step further and say, hey, we know that we'll have recessionary conditions every, whatever it is, decade or 7, 8, 10 years, whatever that number is. And that's why that plan is so important. So yeah, I like that. I think
you're paid handsomely. You're paid very handsomely for that volatility. You're paid like double or triple or quadruple what you can get in guaranteed investments. So it's absolutely worth it. And if you compound that over 10, 20, 30, 40 years, your kids and your estate get, millions or hundreds of thousands instead of tens of thousands and hundreds of thousands.
Yeah, like I would add that the fact that the markets are up or down is immaterial in the sense in the long term, because I checked my income of my portfolio, and it's actually up slightly from better than last year, because a lot of the good stocks that we have, have increased their dividends. Sure, like 1,000 stocks have gone down, but hundreds have stayed the same or gone up and increased their dividend. So the income, if you're a long-term investor and you don't have like shitty stocks or whatever, and that they pay dividends, you're collecting your dividends, and just relax. There's no problem.
it's pretty good ad for diversification too, right? So good asset allocation, a good relationship with your advisor, good diversification, and all of a sudden, all of these, exactly, don't speculate. Maybe try to stay away from day trading. These are all things that really, really reduce the importance of that question: when is the market going to come back?
Well, I mean,
quickly sorry, go ahead.
I'm not against speculating if you know that you're speculating. So you're a young guy making lots of money, and you feel like speculating. Fine, speculate, but know that if you're wrong, it's going to cost you a lot of money.
Yeah, know that you're gambling.
We're in the business. We're in the business of pension style management, where the preservation of capital is utmost, and getting income from your portfolio, from your assets. So there's no speculation there, right? It's there's portfolios that are made that it doesn't really. I mean, you prefer to have the stock market up in case you want to sell, but whether it's up or down, it changes nothing. If you're investing for the long term.
Yeah, I think that's a good summary.
To try to answer Richard's question more directly, historically, the year before the US election, this third year is usually a strong year. And also historically, I had pulled up this chart. I was going to show it, but I don't want to screw it up. But historically, year in, year out, and in this third year, the market historically bottoms in the month of March. Historically, on average, if you look at the last 60 years, I believe the actual bottom is somewhere around March 12th or something like that, historically. Now, that's obviously past that. As Tanya, did you want to put up Or Diggs, did you want to put up a question?
Yeah, we can put up our next question. Sorry, I don't know if I was having internet problems on my end. You were just frozen there for half a second. So maybe this is my end. But if we're ready for the next one, Diego, do you want to put up the next question for us? All right, given what has happened to interest rates and the bond market over the past year and a half, should we be buying bonds again? This question's from Randy. So Rob, I'm going to let you go first on this one.
Okay, so the answer, so this question begs the question, I think the question is, should I be selling stocks to buy bonds? So should I be selling stocks to buy bonds? So the answer to that is likely no, because that changes your asset allocation. There's a reason your asset allocation has been built, and it's probably something to do with your volatility. Now, if we're talking about selling another piece of fixed income in that bucket, in that fixed income bucket, so maybe private debt and buying bonds, there's certainly a pretty strong argument that could be made here that, bonds were minus, what was I think it was down like 14% last year. XBB was down 14% last year, or 13, something like that. Rates go down, bonds are going to appreciate in value, and your bond that you bought that pays 5%, a 30-year bond today that pays 5%, if interest rates go to 4 or 3, they appreciate in value and they show nicely on your statements. You're still collecting the same income, but they show nicely on your statements. I think there will be a time here in the near future where it will make sense to come from traditional or from alternative, largely avoiding and explain why. 1%. Am I the one who's lagging here, or?
I'm not sure if I was lagging or you were. So I didn't hear anything you said. But to answer Randy's question is, yeah, there's nothing wrong with fixed income's been around a long time. I personally think there's better things to do. But to answer your question, if you're going to put your money, let's say, in a bank at 5%, I always come out with this alternative.
A bank stock or a GIC?
A bank stock. No, a bank. Go to your branch of one of the Canadian banks and put your money at 5%. Okay.
And a GIC, in a term deposit.
On a GIC. Okay. There's nothing wrong with that. 5% is a good return, and it might be the best return for the next 12 months. I don't know, or maybe 3 months, 6 months. I don't know. But here's what I do know. I do know that the same bank that you're dealing with, okay, I would go in there and instead I would buy their shares. The bank stocks right now some are trading as high as 6.5, some as low as 4, but the average is around 5-ish. So let's call it 5%. So here you have an institution that it's volatile, but let's take volatility away. So you're going to get 5% in their GIC, or they're going to take that 5% and make 15% return on equity they've made since 1934 for the last 90 years. Okay. And they pay a 5% dividend, but because they're trading at only 10 times earnings, most of the banks between 9 and 12, in 10 years, in 10 years, you're going to have all your money back and you will have received 10 years at 5%. So I'm a big cheerleader of buying equities over fixed income, but it has to be the right equity. So I'm not against fixed income, Randy. I just think unless your situation is different, you need the money next year or something like that, unless there's good reasons. But if it's long term, I'm not a big proponent of that.
And the reality is that for us in our job, we're always going to be doing whatever risk analysis is necessary in order to choose the right tool in our toolbox. So typically, if you're going to be buying bonds, it's because you're looking for something without volatility that produces income, right? So that would fall in that kind of bucket, for that toolbox. And so we would want, as Rob was saying, if we were going to be buying bonds, it would be as a tool for that. So perhaps it would replace something like private debt or mortgage-backed investment or some prefs or something like that. So I think it is really important to, again, I feel like I'm a broken record now that, hey, you need to have a good relationship with your advisor, because then your advisor can pick the right tool for the job, and whether that happens to be bonds or whether that happens to be something else.
Yeah, and remember that bonds are in a portfolio for one specific purpose. Typically, it's to reduce volatility, because we know you're going to generate more returns owning equities. It's been proven the last 100 years of data. My dad mentioned it. You're going to do better if you own stocks. We know that for a fact. So why would you own bonds? You would own bonds because you want less volatility. You want to be able to sleep at night. You don't want to see your portfolio go down. So that's why people would own bonds. Does it make sense to own them at 5% versus 1%? A heck of a lot more. It makes a heck of a lot more sense to own at 5% at 1%. At 1%, I was talking everyone I could try to get away from the concept of buying 10-year paper. But at 5%, and you really can't stomach volatility, it makes sense. They're better than GICs because you're going to get liquidity. You can sell it and you can convert it to cash. You don't have to hold it for 5 years. But I mean, you also have the slight risk. I don't know, Claude. Significant risk, slight risk of interest rates continuing to go up and the bonds getting hurt more and more. You know, if you were to have bought bonds in 1980, 81, when they were going up and they hit 5%, you would have got killed, because they went all the way to 18%, and your bond portfolio would be worth pretty much zero, right? Like not quite zero, but not a lot. So is it too early to buy bonds? Maybe, but we're certainly looking at it.
Great question. Thanks, Randy. All right. Well, as we kind of transition here to the next topic, I just want to make sure everyone is subscribing, hitting that like button. Make sure that you send over your questions, put them in on the comments here. And looks like we have a brand new one here. So this one's about gold and crypto. That's such a great question. This is going to be good opportunity to kind of explain how this works. So the question is, why have gold and crypto rallied over the last few weeks? I think, Claude, you can start on this one. I feel like this would be a nice one for you to explain.
Well, I'm not so sure I want to talk about that, but
anyway. Well, why don't you start with the gold? Why do people usually buy gold? Maybe we could start there.
Well, gold, and I guess you could say right now, crypto's the same, but historically, gold has been, in inflation, it's done well, because during high inflationary periods, currencies go down. So if you're in any country in the world and your dollar becomes worthless because inflation, too many dollars chasing too few goods. So the more dollars you have, the less they're worth, right? So if you want to go to another country or go anywhere else, you have no more money. Like in Zambia, they devalued. The smallest bill was a 1 million, whatever they were, because and people lost everything overnight. So whereas if you had a bar of gold, you could have brought it back to Canada here. So crypto is a different story.
Okay, wait, Claude. You said a lot of things there, but just dumb it down. Gold is a hedge against inflation, right? Just dumb it down, and why gold is up right now.
Yeah. Well, gold is
gold's a hedge against inflation, right?
It's a hedge against inflation.
And it's when people feel like cash is not worth what they think it should be worth, people are looking for other, right?
Right, because when inflation hits, the value of your dollar goes down. Okay, so if your total net worth is $100,000, okay, and inflation erases it at 10% a year, you will have a buying power of 0 in 10 years. Whereas if gold maintains its value, and it can be transported to anywhere in the world and exchanged for a currency that has not gone down, where there's no inflation. So that's and gold is really
that's the train of thought, right? What would you say counter to that is the actual reality when it comes, the logistic reality of holding on to gold and the logistic reality of holding on to crypto.
Yeah. Well, it's changed now because now the central banks are controlling inflation. So I would add that there's probably no more reason to own gold. Okay. Well, I'm not saying there's not a reason to own gold, but there's less of a problem with governments around the world in industrialized countries having central banks that make sure that inflation is like we're seeing right now. They're fighting inflation at all costs. And therefore, gold doesn't pay any interest. There is no return or anything. So why should you own gold? But that's a debate that we could go on for hours and hours. Cryptocurrency, I mean, it's only been around, 5, 10 years, 15 years. We don't, there's so many things we don't know about. I can't comment whether I certainly wouldn't buy any personally, but it doesn't mean I'm right about that. I mean, if you want to hedge against inflation, and I had to buy crypto or gold, I would buy gold, but because it's been around for thousands and thousands of years, and it's a short history, and it's more controlled. There's less of the criminal element in there, blah blah blah, and all that stuff. So that's my answer.
I think we're missing a piece of this answer to this question, which is what's happened in the US over the last 2 weeks. So the other reason that gold and crypto are rallying right now is because the US dollar is seen to be less strong. And there are certain individuals and buyers that are convinced that it's the end of the world and it's like the apocalypse is coming and we need to put gold under our mattress because nothing will be of any value and it's the end of the world. So the end of the world, the end of the world scenario, gold does well. Gold does well because if ever it's the caveman days again, I could take my bar of gold and I can go and trade it for a wheel or a slice of pig or whatever it may be. Now that's absurd to me, and it's like it's so far from the realm of reality that's why it's moving as well. And crypto, surprisingly, Claude, like you and I talked about this last week, I thought, given what happened with SVB and the New York bank, the New York regional bank, like there were some crypto ties to that. I thought crypto would fall. But I think two things happened. One is I think buyers saw that the government was willing to back deposits held at banks that focused a little bit on crypto. So it kind of like justifies or legitimizes crypto in some twisted way. And then two, I guess, is it's the same kind of hedge as gold. I guess they're saying if the US dollar is not safe, Bitcoin is safer. And Bitcoin went from 20 grand to I think 26 grand. But anyways, I think that's a little bit of what's happening. It's a lot of buying for people that are listening to noise.
I would agree.
We advise not to do.
Yeah, I would agree. I think what's happening is there's just a sentiment that somehow the system is somehow flawed and that there is like no guarantee that, traditional currency would be worth anything. And those people who have a tendency to kind of go a little more towards those, like Rob, you say, those apocalyptic and end of the world as we know it kind of stories, would, they're looking for other types of currency that they feel would act as a hedge. So what do we think are better hedges? What would maybe for inflation, real estate? What other ones here can we talk about that are really have a much better track record? Because I don't know, I think about even just gold, like even if it was the end of the world, like gold is heavy, and where are you going to go? You're going to walk on foot somewhere in your cave, and like, who are you going to go give your gold to?
It's absurd.
How are you going to eat food? Like
your point about other investments that are natural hedges to inflation, that's what we should be talking about. And good for you for bringing it up. Farmland does remarkably well because there's less and less farmland available. There's more and more people. Inflation is fewer dollars chasing more goods. The farmland produces those goods. It captures inflation remarkably well. Real estate is another one. Anything that's any stock that is able to pass on the inflation to the consumer is also a good idea.
How about gold mining companies? Maybe that would be a better option.
But I mean, if you want to participate in gold, buy a company that's profitable at least. And that if you think gold is going to appreciate in value, at least if you buy a gold company, they're profitable, and at least you're going to get profits. Claude, I'm sure you have thoughts on that too.
Yeah, the best hedge in inflationary times is to have what they call real assets. Okay, and real assets are assets that produce something, an income. Okay, and that's why real estate is probably even though the real estate stocks have gone down, it's well, I'm not supposed to recommend anything, so I won't say anything other than real estate that produce income day after day. For example, an apartment block that people pay their rent every 30 days, whether we have, and get this, if there's inflation and everything goes up, guess what happens to rents, right? Everybody's complaining that rents are going up. So to me, it's a way better hedge against inflation is to have real assets. And there's others. There's not only real estate, but everybody's familiar with real estate. So if you own a good portfolio of rental properties, there's not only rental, there's commercial properties and other kinds of properties, farmland, Rob mentioned, but real assets, assets that produce revenue regardless of the economy.
Can you pass on the inflation to your consumer? Can you be on the other side of the trade is the question you could be asking yourself. And with the alts that we do in our portfolios, like I think our farmland was up like 16% last year. I think our real estate overall was up, I think 8 or 10 or 12, something like that. We had some infrastructure that was up, I don't know, something like that, 8 or 10. And those are all really good at capturing the other side of that trade. Good, really good point, Tanya.
Yeah.
All right, so I'm going to check to see here if we have any other questions coming up here. But while I do that, I'd just like to encourage everyone to give us a like, a subscribe on our YouTube channel. If you have any more questions, make sure you post them in the comments and we'll try to get to them. I don't know how much time we have here.
Can we address maybe real quick, Claude, your thoughts on SVB and the U.S. government
I was
stepping
just going to
in?
interrupt.
Yeah, we didn't really cover that today.
I'd like to make a comment on SVB. Is that
Silicon Valley Bank, for those that are
Silicon
watching?
Valley Bank, and there was another one in New York.
Yeah,
I forget, Republic, or there's quite a few. Anyways, the point, like, it's all over the news, so you can read it. I'm not gonna. But this was the problem here was unlike 08, 09 or other times. The problem was a mismatch of deposits and loans. So. And I'm not going to get into it. I think you're all familiar with it. But the point I want to make is we've had this before. I've seen this movie before. And you know what? We're going to be okay. This is going to blow over. The people that will lose money are the shareholders of these unsafe banks, okay? And they took too many risks and they're going to lose money. But it's not typical of the banking system, okay? It's totally nowhere as close to the Canadian banking system, whereas there's a more regulation and deposits are safe and they have to have reserves and all of that. So it doesn't matter how bad it looks right now. And that's all they talk on TV now, every day, 15 hours a day. It's the end of the world. It's the end of the world. It's not the end of the world. You know what? I saw it in 87. I saw it in 08, 09. And you know what? Markets went to all-time highs, whether it was 6 months later, a year later, or 2 years later. And it's self-correcting. It's getting rid of the abuse. It's getting rid of the bad actors. And we're going to come out strong out of this. And your investors will do well. It's just relax and don't sweat too much the bad news in the next 6 months or so.
So you're saying this was a risk mitigation issue with a niche bank dealing with startups in an area that's not regulated in the same way here. But I guess we're still seeing a little bit of kind of just fallout on the financial sector equity side. You think that'll be pretty short term, just kind of investor
that's just
sentiment?
Emotion, right?
Yeah,
that's just emotion. That has nothing to do with
it's just sentiment. Yeah,
if there's no contagion to Canadian banks.
Absolutely not.
I'm pounding the table here and I'm saying there will not be a Canadian bank that will go under, period. End of discussion. Stop the conversation. That's not happening.
But even those banks, if management are not mismanaged, they were taking money on lending it and then investing it for 30 when they should have been matching. If the loan is for 5, they should have invested it for 5. The loan is for 1 year, invested for a loan. We wouldn't have this problem because it matches. When the loan comes due, the savings comes due. But
you would think that would be banking 101.
Yeah, it's banking 101, but they didn't do it, but that's
clear,
only a few banks that did that.
Yeah, to be clear, they had long-term bonds that they had on their books at face value. So let's call it $100. There was a little bit of run on capital. So in other words, people needed cash. Companies needed cash because the tech sector is not doing fantastic in Silicon Valley. They pull out some funds. The bank says, I now need to create liquidity for my clients. I need to, because they don't keep $100 other in. You deposit $1 at the bank. What is it, Claude? 90% of it goes out, or something
they
like
lend,
that?
let's say 85%, and they put the other
85%.
15% in a portfolio of treasury
Bonds.
bills or bonds. Yeah.
And they bought 30-year bonds. Now the bonds didn't go bankrupt, and they didn't go bankrupt. What happened is when they liquefied those bonds, they had to sell them at at market value, not at face value. And because interest rates had moved and they hadn't matched their deposits, bad banking, all of a sudden you have bonds that are worth 80 cents, and now they have to crystallize a loss on paper. And then people got scared, pulled all their money out, and it's by the time they made it public, it was game over for that bank, just because they didn't match their deposits. Like the bank itself, anyways, it's a weird one-off story. But again, it wouldn't happen in Canada, but it also, like, the U.S. What do you think of that, Claude? I want to ask you that question. What do you think of the U.S. Guaranteeing those deposits?
Well, it's a debatable point. I'm personally against it, rewarding mismanagement or people. But on the other hand, I don't think it's the responsibility of a U.S. citizen or a Canadian citizen, somebody who drives a truck, work on some constructions, was a doctor or a nurse or anybody, that they have money, they want to put it in their bank, and they won't have confidence that their bank's not going to go under. A lot of commentators are saying, well, it's their problem. They should have checked if that bank was safe. But they're on the side of consumers. But you can bail out the depositors, but as long as they don't bail out the equity shareholders, because there's a difference between depositing your money, your check, saving $50 at the end of every month or $100, and investing $250,000 or $500,000 in a bank. There, you're taking a risk, right? You're investing in equities, and if management doesn't manage properly, you're taking the risk. You lose all your money. The government shouldn't bail you out, but the depositors make sense mostly.
I think, and just to add to that, that's a great way of putting it. So if we go and we buy a stock, I don't know, a Home Depot or a Walmart or whatever, and Walmart goes bankrupt, we wouldn't be saying, government, can you make me whole on that stock? Like, I bought it. It shouldn't go belly up. But the deposits, I agree. And I think it's a remarkable signal that if anything, the market should be up, because the government has basically said, we're not going to let you guys lose any money here in these banks, right? Like, it's a pretty strong statement from the government to guarantee. They already have the insurance in place, and they go above and beyond, and they say all the deposits are safe. I think it's a pretty strong statement. And I mean, in Canada, think what you will about our government, but there's no way, like, Canada would have acted. I think our Canadian government would act even. They're so proud of our banking system. And if something were to happen in the Canadian banking system, which I don't think it's possible to happen, Canada would write a blank check. Do you agree, Claude?
Yes. No, I agree. But just to continue on who's going to lose money and the contagion and all this, the U.S. banks, it is that the reason these regional banks are down like 80% or 90%. If I own shares in another small regional bank and didn't know of management that had mismatched their deposits, I'd be worried, right? And what would I do? I'd get out. So the deposits are safe. The banking system is safe. It's, as an investor in shares, in equities of a small bank, Are my investments safe there? And that's what's happening right now in the market. And we don't know, because even the regulators, auditors have said, at a certain point, yeah, everything's good, but they don't know. But your deposits are safe. The banks are safe. There is no issue. If you invest in a small, like we don't do that kind of thing, but let's say you want to take a risk, because these guys were trying to make 15% instead of 5%, and it blew up. So if you want to go in, and that's like speculating rather than investing to make 15 when the going rate is 5. You're speculating. That means you're taking on additional risk. And you know what? If this thing happens, sorry, you took on the risk. You're going to have to lose
in your equity holdings as
in
an
your
investor,
equity.
as an
Yes,
investor in the stock,
in the stock. Okay,
not as a
not in your
depositor.
deposits, in the
Yeah.
stocks. Okay.
Yeah, I think the depositors' signal was very strong and
Yeah.
very clear from the U.S.
Yeah, and I think it should be enough to help with overall sentiment and the fear out there. And I think it is an important distinction to make between the equity investors and those who are looking to just deposit their cash.
The debate, Tanya, all over the world is not the 250 guarantee that the government said, look, we'll pay you right away your 250, don't worry about it. It's the over 250,000. Now, is that your average consumer that needs protection? That have over 250,000. So the government there and FDIC, the guarantee of those deposits are kind of saying, well, look, you're sophisticated. If you've got $250,000 in there, well, then maybe you have to do additional due diligence to make sure that the bank you're dealing with is safe. But the normal consumer, which is 95% of the people that have less than $250,000 in a savings account in a bank, they shouldn't have to worry about that.
Yeah. Maybe I should just comment real quickly on in Canada how it works with the assets at a firm. So if your assets are at a firm like ours, an investment industry regulatory organization of Canada, an IIROC firm, and you can Google this if they are or not, a member of the Canadian Investor Protection Fund, the CIPF. There's two things that are happening. One, your investments, so the shares you own of companies, stocks, bonds, etc., they are segregated, which means that you own them. Me, or the firm Canaccord, we do not own your securities. We are custodians of your assets, which means you own them, which means if ever something were to happen to an investment firm, I just want to run that scenario in case some of you are thinking through it. If something were to happen to the investment firm, an insolvency, a bankruptcy, you continue to own your shares of Walmart or Nike or Tesla or whatever. So there is no impact to any of the shares you own. You continue to own those shares. They are segregated. You own them. So they're not mine or Canaccord's or anyone else's.
Yeah, no need to do a bank run for your shares.
Don't need to do a bank run because you own something else, right? You don't own Canaccord stock. Now, if there's cash in the portfolio, so cash would mean actual cash, not money market, not short-term investments, actual cash. The CIPF guarantees $100K of cash for each account, for each Canadian, for each account. So by rule, for us, we don't keep cash in the portfolio. So, if we do, for whatever reason, need to have a short period where we want to have short duration or we want to keep liquidity, we would invest that into a short duration kind of money market fund or a short duration fixed income fund. Those are typically yielding around 5, Tanya, 5.25 right now, something like that. So we would put our clients' money in that. So we don't have any exposure for our clients ever to an insolvency by rule here. So just in case that comes up and you want a peace of mind, that's an insolvency in Canada would not impact any of our clients' portfolios for our bank, for our firm, or our back office.
And then there would also be depository insurance at your actual bank if you're with a Canadian bank. So for your savings account or,
Now you shouldn't be keeping more than $100,000 at your deposit bank, but if you are, that portion in one account could be exposed. But again, I don't know what the government would do if there was an insolvency of a small credit union and you happen to have more than $100K at that bank. I don't know, but you should maybe look at that. I don't know, Claude, if you have thoughts on that, but
Well,
a detail.
there has been precedents. A couple of small credit unions and the provincial governments, where credit unions are most of them are provincially regulated, and the government came in and they guaranteed all the loans.
Yeah.
Nobody lost.
We're not saying that that's going to happen, but just to be
Yeah.
clear, we're saying the rules, right? That don't take
Yes.
this as
Yes.
investment advice with respect to
Yeah.
your 100K that's sitting
Yeah.
at the credit union. That should be
If you
invested.
do have
You should
100K, you should invest it.
that should be
Definitely.
with us. That should be with us. Do we have time for this last question about dividend paying stocks? We could debate this for hours. Maybe just show it. This will be our last question. Diggs, the dividend paying stocks question.
All right.
I'll try to answer it quickly.
So this one's from Lewis. Dividend paying stocks typically are not as volatile. Why wouldn't most portfolios have a larger percent of dividend paying stocks? You can't get it. There's ain't no such thing as a free lunch, Lewis. That's pretty much the answer to all the questions, but I'll let you answer it faster.
No, yeah, you got it. So basically, if a company is profitable, there's two things they can do with their profits. One, they could choose to they could choose to distribute it to unit holders, to stockholders. As an owner of a stock, I can get a dividend. They can use that capital to buy more shares, buybacks, or they can spend it on their further growth. Companies that pay a dividend are typically mature companies that have less interest in dramatically growing the company. They're going to distribute the profits because they're content with, making money, giving you the profit. The other side of that equation is they typically generate less returns, total profit, than growth companies. A company like, I don't know, Google or Amazon. They use all of their profits and they go and they expand, and they're able to generate much more returns than they can with the dividend stock. So the answer is not you need to have all of one or all of the other. The answer is a well-built, diversified portfolio should have some dividend-paying stocks, and they should also have some growth, depending on your risk tolerance, depending on your asset allocation. So you should have some of both, and depending on who you are, you could have more of one or more of the other. But there's no magic formula, because think of it this way. Imagine a company is only making 6% return on equity, okay, for their shareholders, but they're paying out all of it. They're paying out 100% of the profits to the dividend holders. That means you're collecting a 6% dividend, but you will never get growth, right? So that's it. You're buying a $100 stock. It's always going to be at $100. It means you're only making 6%, whereby most growth companies will make 10 or 15% return on equity, and then they're distributing 0% of that. So what happens is the stock appreciates over time. Hopefully that was an answer that made sense.
Yeah, and just to further our question is that if the stocks that don't pay dividends are more volatile, okay? So that's why you're seeing some of the greatest companies in the world that don't pay dividends, they're up and down, whereas the utilities that Rob's example of 6%, they hardly ever move because you're getting your 6 regardless.
But even that's not true, Claude. Like utilities, bank stocks, insurance companies, they all fell 30% in 2020. All of them.
True, they fell almost as much as the NASDAQ stuff.
30, 35. Like the NASDAQ was down 50, but they were down 30,
Yeah.
35. So yes, it's a little less volatile, but if you're down 30 or 35, it's not like owning a bond, right? It's not like that. So, in our minds, it's a little less volatile, but like proof is in the pudding. They are down. There have been periods, like if you look at XFN, XFN fell 40%, 35% in 2020. The utilities fell the same. So there's no way to hide.
If you're only making a 5-6% dividend, then maybe you could and not getting no growth, someone could argue that maybe it should be in a GIC or fixed income, right? You could.
Yes. Yeah. I mean, it's a lot more tax efficient, but yes.
Yeah. Yeah. So yeah, I think the answer to there is it's good to have both. Good to have both, especially if you're looking for some growth. Great question, Lewis. So I think, is that going to be it for today?
Yeah,
I think we've been at it for over an hour here. So thanks so much for joining us. Thanks, Dad, for joining us today, and Rob for answering all these questions. Everyone else for joining us. Thanks for sending us questions, and we'll see you next time. Have a great afternoon,
guys. Don't
everyone.
forget to subscribe. Don't forget to subscribe.
Like, subscribe.